Corporate finance practice problem using Excel. Residual claim to earnings. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. If you have access to Excel and would like to follow along, note that we're in the Practice tab as opposed to the Example tab. The Example tab, in essence, being an answer key. Information's on the left-hand side. We're going to populate that information on the right-hand side, going through a quick calculation of the residual claims to earnings. So we have our earnings are going to be the $20,000, paid interest to bondholders of the $6,000, and paid dividends to the preferred stockholders of the $4,000. So the residual claims are basically the residual, what's going to be left. So our quick little calculation here, we're just simply going to take the total earnings, which are going to be then the $20,000. We're going to then subtract out the amount paid to the bondholders. And this is going to kind of emphasize the fact that the bondholders are going to generally have the first claim to the earnings, right? And then we got the paid to the dividend to the preferred stockholder. The reason they're preferred is because they'll typically have claim before the common stockholders, and then the difference is going to be the residual claims to earnings. Summing that up equals the sum, which will actually subtract it out, the 20,000 minus the 6 minus the 4, giving us the 10,000. Let's put the underline underneath, font group and underline. So this kind of emphasizes the fact that if you're talking about the who's going to be paid first type of situation, typically the liability, the debt, is going to have to be paid first, and then you're thinking the dividends or the preferred stockholders next, because that preferred stock is kind of closer to like debt or than equity, right? It's equity that's kind of similar to debt. That's why it's going to be preferred. And then you got the common stockholders that would have more claim to the what's going to be left over there. Now, notice when you do a calculation like this, it leads you to believe that the common stockholders are in the worst position. And if you're talking about are you guaranteed to get paid, that is typically the case, right? If something goes bad, if there's a bankruptcy or something like that, theoretically, unless the government comes in and does something funny, theoretically, the way it's supposed to work is the bondholders, the reason they're a bondholder is because they should have less risk on that case, and they should get paid first generally, and then the preferred stock, and then the common stockholder. But the reason you would still want to invest in the common stock is that if this residual income was to increase and increase, what's going to happen with relation to the bondholders? Nothing. They're still going to get paid the same amount. What's going to happen to the preferred stock? Nothing. What's going to be happening to the claims of the common stockholders, basically the owners of the company? It's going to increase. And that's why you're taking on more risk as basically the owner, but you're also having more potential rewards. If there's increases taking place, then you're going to have the increases. Obviously, if there's a problem, just like if you were the owner of the company and your company went bankrupt, then you have to pay off, the other people, right? You got to pay off the liabilities, and you get to keep basically the residual. If the company does well, then you pay off the liabilities, and all the excess basically is yours. Is the general concept. It's a little bit more cloudy when you think about that as an investor or these large companies, or a single investor that's investing kind of passively or something like that. But similar concept applies. If you're investing in the bonds, you don't have that potential reward of the increase if the company does really well, but you're quite likely to get paid off. If the company does less well, you have less risk than you would think the common stockholders in general cases, unless again the government comes in and decides to rework the whole thing, like if the company's too big to fail or something like that happens.